Good afternoon, everyone. This session is really between the lunch and, and we are here, but thanks for keeping the patience and you're all available. The house is full. Grateful to all of you for being present here. So we'll quickly take this session and run through. We have a very good and esteemed panel here, highly experienced tax professionals. And so I'll request each one of them to have a quick introduction. To my left is Mr. Nipun. I'll request Nipun to introduce himself.
Yeah, good afternoon, everyone. I am Nipun Mohanka. I head the tax function for India and APEC region for DIAGEO India.
Hi, good afternoon, everyone. Myself, Sshrey. I head the tax function for Flutter in India. Thank you.
Hello. Hi, good afternoon, everyone. I am Gurmeet Sukhija. I head Indirect Tax function for Mankind Pharma.
Good afternoon, everyone. My name is Shailendra Jindal, and I head the taxation operation for the Goodyear India. Thanks.
Hi, this is Vaibhav. I head the tax for the Perfetti Van Mill Group for the Samena region. Thank you.
Thank you, everyone. And now I introduce myself. I'm Sanjay Gulati. I'm the group EVP and group head for GMR. And we are into airports and infrastructure and power. That's what we are. So here we start the session quickly. We see that the way tax reforms are going on and there are so many regulatory reforms are taking place every year, and particularly 25 has been the year of tax reform, where we had direct tax, which has been new direct tax code, which was implemented, and then changes in GST 2.0, which was announced by the Honorable Prime Minister. Thereafter, we have regulatory changes and so on. So with this evolving regulatory environment, we have more particularly on the taxation side, both direct tax side and the indirect tax side, we have a lot of challenges for the purpose for businesses, and businesses have to gear themselves up. They have to make themselves ready to ensure that they are able to match with the regulatory pace. The way the kind of scrutiny which is happening, so it's important to have the right governance framework in place in order to ensure that we are protected ourselves from any tax risk or any such challenges which come from the government. So, and the expectation of the government is also there, and which is true and correct, because the tax code is there and we have to lay our compliance process, compliance framework, etc. around that, and we have to ensure that it remains in place and it's rightly, taxes are paid and compliances are executed within the time frame, and the tax efficiency is built up and all that. So with this, I request Nipun to speak about the tax framework and the governance framework around that, and how the industry is getting itself to match with the regulatory expectations.
Yeah, thanks, Sanjay. I think governance is one of the interesting topic we are having in our industry, boardrooms, everywhere. So for me, the robust tax governance system for tax, I would say, is basically looking into how do we turn no surprises into the DNA of the organization? How do we build that into the life of the organization? And over a period of time, this concept has evolved. The framework has evolved significantly. So let me share this with a story, so which all of you can resonate. Early in my career, when we were talking about risk mitigation or managing risk, we were looking into the rear view mirror. That is, once the year ends, we used to file our returns. We used to file responses to the notifications or the notices, and finally defend our positions. Now, this approach may not be sufficient in today's world. What helps in today's world is the integrated governance framework, which which is both forward looking as well as backward looking. So when I say forward looking lens, it means we focus on processes. Tax is embedded in each business process at the start of the transaction itself. Alok did mention in the morning that yes, how businesses are involving tax function for each and every transaction. So when businesses are making decisions, be it start of a new product line, be it change in route to market, cross charges, service agreements, and even people movements, all these things, tax is involved upfront. Clear risk appetite, standard playbooks, and kind of documenting the decision making, all these three things help in kind of navigating the tax issues. So that's point number one. And I want to just give you a quick example how forward looking lens can work in an organization. So suppose an organization wants to set up or start a new management and control contract with its parent company. The authorities, there is one possibility that if you don't do anything at the start of the agreement, the authorities are going to come back for asking for benefit test, asking for margins, and all those things. So what an organization can do is to build a strong playbook governance framework to manage this risk. What you have in that playbook is clearly services are defined, the pricing methodology has been defined, and contemporaneous documentation is clearly documented. All this will definitely help in preventing your transfer pricing disputes by design and not by defense. So that's the key thing. How do you defend your position by design and not by defense? Two, I talk about backward looking lens. We talk about internal controls and preparedness for the audit. So when we talk about internal controls and preparedness, few things like robust compliances, reconciliations on real-time basis, and timely reporting to the management, coupled with AI tools. We talk throughout the day about AI tools. If you combine together, you are able to detect issues well in upfront, and you are able to respond to the authorities well in time. And what connects these two lenses, which is the forward-looking lens and the backward-looking lens, is basically the strong governance. So strong governance plays an important role, both in terms of how you protect in terms of future risk and at the same time your past risk. So in nutshell, if I have to say what a strong governance framework should look like, it should be an integrated framework which will help to kind of manage the risk for the organization, helping the company to manage risk and move with speed, but with the confidence at the same time. And lastly, in this today's world, managing speed and certainty are two critical things which define the strong governance framework.
Thank you. And it's so true. Without a proper and comprehensive governance framework, coupled with these two lens, perspective, which Nipun you have given, it is very important that organizations need to be prepared. Now, I also look into to say that how would board looks at it? How board reacts to it? What are the expectations of the board, and how do we present to the board? So I'll request Vaibhav to throw a light on this perspective.
Thanks, Sanjay. So, in this world where, especially for the listed companies, all the tax related risks and all the tax related issues are all highlighted, and you have to, present it to the SEBI and to the board. So it is very, very important that you speak. First of all, you need to be very, very upfront with the board. You need to mention that, okay, there is a risk. This risk is, let's say, more likely than not, or is it remote? And you have to have the real backing from, let's say, a council opinion, and you need to be very, very upfront on that. That is one. Second is, in terms of what is the cash flow impact of that for the organization. So you may take a call that you want to save the cash flow because you think you have a good case and you don't want to pay. So you take you go for stays and those kind of things. But if you think there is a challenge there in terms of your let's say matter being a 50-50 kind of a situation, then possibly you may like to pay more tax upfront in cash, because then what happens is you save on the interest liability, which matter may take 10 years, 15 years to resolve, right? And then later on, the thing is that as and when you keep on evaluating your overall tax risk, and as and when, if at all you feel that because of the jurisprudence or any other things, you think that your case may become weak, or there is a good amnesty which is there, you may like to inform the board and you may want to settle the issue. So these are very, very important things. And the last thing I want to mention is that, the tax risk these days is very, very threatening for some of the organizations. We have seen situations like AGR issue in the telecom industry, because of which some of the the telecom players have basically vanished from the industry. Or we have the entry tax issue, or we have similar other issues where the whole industry has got impacted. So when you are taking any position, first of all, you have to have a proper reasoning for it. You have to be 300% sure for that, and you need to keep inform the board about what is happening, and it has to be transparent and speaking in their language. I think that's the most important thing. So I think very, very important these steps.
Yeah, no, that's very true. Again, what are board's expectation and what we expect from the board? I think both have to be aligned. And one thing is that the forecasting of risk is the role of a tax function, which tax function, updates the board. And gaming industry is one such example where, all of a sudden a kind of impact which the gaming industry has seen, which led to a huge unexpected demand of taxes, and second, which business had not factored, and third, their business continuity was basically impacted. And looking into that, I now go to a key tax hot topics, and one of such is that the emergence of these areas where how do we plan for it? How do we forecast those kind of tax risk? So over to Sshrey, and kindly throw a light on the impact you had on the gaming industry, and how do you see this to be managed?
Sure. I think we have heard the buzzer ring twice, but I'll just try to wrap it up quickly even before starting. So I think just like the buzzer here, the gaming law change was also a surprise to all of us in gaming industry. I mean, we were already fighting a huge $1 billion litigation with the GST tax authorities in India. And then, this is one of its kind law which came in, which banned the gaming business completely over a span of 72 hours. Just to go back into the issue, because I mean, most of you are tax folks. I mean, initially when, the GST law came, all the gaming companies were paying 18% GST on the platform fee, versus the government then said that let's milk the goose even more. And then they said, we'll increase it to 28% on the deposit value. So let's say if there's a player, he deposits 100 and spends 10 out of it, we were now supposed to pay 28% on 100 rather than paying 18% on 10 earlier. Now, when that was going well and companies were doing well and more and more players were coming, they decided to completely ban the law. Now, the irony is they have allowed two types of games. One is, social gaming, if I may call it, or casual gaming. And the other is the multiplayer gaming. Now, you would remember when GST 2.0 came, when the rates were subsidized, changed and everything, the gaming for that matter was still taxed at 40%. So it was treated as sin good, whereas the gaming per se was banned. So I believe the finance minister herself was not aware that PMO was going to ban the gaming industry. But having said that, right now, the entire industry is looking to probably foray into new business models and also trying to grapple with the fact whether a particular game form will qualify as a social game or not. Because even today, there's no specific rate for social gaming, just to highlight. And a lot of companies, they're still in social gaming. So these are, I mean, some of the very key business continuity issues that we're facing.
Yeah, no, exactly. That's how the uncertainty need to be protected. And how do we forecast that uncertainty and prepare the board for taking a forward-looking call? And at the same time, the next key hot topic is the impact of tax, and what is the impact of tax, that is inverted duty structure. The inverted tax structure in GST is throwing another level of challenge, and post the GST 2.0, it has further enhanced the working capital on account of the inverted tax structure. And here I will request Gurmeet to please touch upon it.
Thank you. As I speak, I already see a time's up on the buzzer, but we were discussing that we have to speak a lot on various issues, but on a time constraint, ideas, honestly, amongst, we are, talking a lot about the positive outcomes of 2.0, GST 2.0, the rate cuts and other things, but this is one of the fallout, I would like to use this word, the inverted duty structure. If you talk to any of the pharma, industry guy or FMCG or auto primarily, the inverted duty structure is a real issue. I mean, there are crores and crores of rupees which has been struck because, so for the, just a brief, that inverted duty structure is that when you have an inputs on a higher side and when you have an output on a lower side, it creates a accumulation of the input tax credit. And on a top of it, government does not allow a refund of inverted duty structure if it happens because of the services that you consume or the capital goods. This is a, while we grappling with the inverted duty structure, there are other ways to it. We are engaging with the industry. We are engaging with the government on a various level, trying to figure out how can this be reduced. On an interesting note, this will also lead to reduction of the tax liability across. Even the government has acknowledged this, that the actual tax liability is going to be reduced a lot.
I think working capital is one of the important factor, because the margins are thin in businesses, and at the same time it is important to protect the working capital, and accordingly there should be a comprehensive approach the government need to take about the inverted duty structure and try to eliminate this kind of a gap between the inputs and the output taxation. So over to Shailendra. The another hot topic is the intra-group cross charges, and we will just take 2 minutes and then wrap up this session. Yeah.
Thanks, Sanjay. So I'll quickly, talk about it in the interest of time. So in most of the MNEs, the most common dispute is the intergroup service charges. So most of the MNEs set up a center either at a global level or at a regional level, like Asia Pacific, EMEA, or Americas, to provide guidance with respect to the best practices to be adopted, to roll out the standard policies or procedure to be adopted, to optimize the cost due to volume and bulk, And the cost of this center is then allocated to the various entities in various geographies on a reasonable allocation keys. So the tax officers, questions and disallow these charges, which is in an inconsistent manner, arbitrarily, without any, solid reason on a year-to-year basis on various grounds, but primarily because of 3 reasons. One is they say charges are toward the stewardship shareholders' activity. I mean, this is a routine guidance because they have invested money into India, so they have to guide. Second is the duplicacy of charges. They say, the particular entity do have their team to operate, to do business, they're the board of directors, over and above these charges are coming. And the lack of demonstration of the need of these charges, the receipt of these charges, and the benefit derived from these charges. So there are numerous tribunal and high court rulings, but in spite of that, this dispute remain.
Right.
So there are key 7 areas which the taxpayer need to take care. They have to maintain strong documentation to demonstrate the need of services, the receipt of services, evidences, the proper detailed working of the cost allocation, which India may not have the visibility, but at the regional level, and the allocation keys, maybe third-party certification, ensuring the, the allocation, and the proper agreement between the two, the right methodology to be adopted. So these are the few areas where the taxpayer need to do on a, not just after the year end, but on a regular basis, quarterly basis, I would say.
Yeah, no,
Thanks.
that's right. Intra-group charges practically has a perspective both from direct tax and international tax, cross-border transactions, plus you have an indirect tax impact on that. So in the interest of time, we have to wrap up this session so early, and considering the fact that taxation today plays a very critical role in terms of managing the profitability, and it impacts the P&L, and it impacts the bottom line of any business. So the proactive and pragmatic approach is necessary, and it is that the tax function need to be part of the business decision making process, so that all the challenges what we are talking about today should not be a postpartum exercise, but rather a proactive approach will leads to integration of tax decisions with the business decisions. So with this, I thank my panelists, esteemed panelists, who have shared their valued and valuable inputs. With this, we conclude the session, and over to you for lunch. Thank you.